open with a strong warning. The dollar does not need to collapse overnight. It only needs to become less necessary. Most people imagine the end of a reserve currency as a dramatic event. Panic in the streets, banks closing, markets crashing, and the dollar becoming worthless in a single day. But that is not how global reserve currencies usually die. They fade, slowly, quietly, politely. First, other countries start trading around them. Then, central banks hold less of them. Then, commodities are priced in alternatives. Then, allies begin hedging. Then, enemies build parallel systems. Then, the world realizes the currency that once looked permanent has become optional. Keyline: reserve currencies do not die when the world rejects them all at once. They die when the world slowly learns how to live without them. Main emotional effect: quiet fear and curiosity. Now explain why the dollar became so powerful. After World War II, the United States became the center of the global financial system. Its economy was huge. Its military was unmatched. Its bond market was deep. Its institutions looked stable. And the dollar became the currency the world trusted for trade, reserves, oil, debt, and crisis protection. This gave America an extraordinary privilege. It could borrow in its own currency. It could run deficits others could not. It could export dollars and import real goods. It could sanction enemies. It could finance wars, bailouts, and stimulus with a currency the world still needed. For decades, this system worked because the world believed there was no real alternative. The dollar was not just money. It was infrastructure. Banks used it. Governments stored it. Companies borrowed in it. Oil markets priced in it. Global trade moved through it. Key line: the dollar became powerful not only because America was strong, but because everyone else built their financial lives around it. Main emotional effect: scale and historical context. Now introduce the turning point. The dollar system depends on trust. Trust that US debt is safe. Trust that dollars will hold value. Trust that treasury markets will remain liquid. Trust that political conflict will not destroy financial stability. Trust that access to the dollar system will not be weaponized too aggressively. But trust is not permanent. Debt keeps rising. Deficits keep expanding. Political division grows. Inflation weakens purchasing power. Sanctions show countries that reserves can be frozen. Foreign governments begin asking a dangerous question. What if the system we depend on can be used against us? This chapter should not claim the dollar is already dead. It should show that the incentive to diversify is growing. Key line: the world does not need to hate the dollar to move away from it. It only needs to fear depending on it too much. Main emotional effect: tension and realism. Now deliver the main twist. People often defend the dollar by saying there is no replacement. The euro has problems. The yuan is controlled. Gold does not pay interest. Bitcoin is volatile. BRICS currencies are fragmented. Local currency trade is inefficient. And all of that may be true. But the dollar does not need one perfect replacement to lose power. It can be replaced piece by piece. Oil in one currency, gas in another. Bilateral trade in local currencies. Central bank reserves in gold. Regional payment systems outside SWIFT. Commodity deals settled without dollars. Debt issued in alternative currencies. This is how the system changes, not through one new king, but through many smaller escape routes. Key line: the dollar's real threat is not one rival replacing it. It is 1,000 small decisions that make it less necessary. Main emotional effect: revelation. Now show the chain reaction. At first, De-dollarization looks small. A country signs an energy deal in yuan. Another adds gold to its reserves. Another settles trade in local currency. Another builds a payment channel outside the US system. Another reduces treasury purchases. Another questions why it should hold so much dollar debt. Each move looks manageable on its own, but together they change the direction of the system. If foreign demand for dollars weakens, US borrowing becomes harder. If treasury demand weakens, yields may rise. If yields rise, interest payments grow. If interest payments grow, deficits worsen. If deficits worsen, more debt must be issued. If more debt must be issued, confidence is tested again. This is the danger. The dollar may not collapse because people suddenly abandon it. It may weaken because the world slowly stops absorbing unlimited American debt at low cost. Key line: the dollar system was built on demand. If that demand fades, the entire American financial model becomes more expensive to maintain. Main emotional effect: inevitability and pressure. The final chapter should deliver the big warning. The dollar can remain important and still lose dominance. That is the part most people miss. A reserve currency does not have to go to zero to lose its empire. It does not have to disappear from trade. It does not have to become worthless. It only has to stop being the automatic choice. First, it is essential. Then, it is preferred. Then, it is convenient. Then, it is optional. Then, it is replaceable. And once a currency becomes replaceable, the privilege begins to fade. America can still be powerful. The dollar can still be used. Wall Street can still matter. Treasuries can still trade. But the era of unlimited trust may be ending. And with a strong closing line: the dollar does not need to die for the world to change. It only needs to become less necessary. Because when the world builds enough roads around a currency, one day it no longer has to pass through it. Main emotional effect: serious, global, memorable.